Rabbit, rabbit. Good morning, everyone. Rabbit, rabbit. Happy first day of the month. It's time for the next in my series of nuts and bolts of personal finance videos. The reason I call them Rabbit, rabbit is because when I was a little kid, my friends and I decided that if rabbit, rabbit was the first thing out of your mouth on the first day of the month, you'd have good luck that month. So having more knowledge, I do believe, brings you more luck. So thus, the christening of my videos. Today is also May Day, which is the traditional celebration of spring, the time when things grow. So of course I thought today I would talk to you about investing. Actually, I'm going to talk to you about when not to invest. I can't tell you how many times people have told me they're frustrated because their money is in the bank, quote, earning nothing. And you know what? Sometimes that's perfectly okay. That's exactly where it should be. So when should you not invest? And remember, I'm an investment advisor. One of the things people pay me to do is invest their money. And very often I tell them not to, or not to invest all of it. So when should you not invest? If you have short-term money, meaning money that you're going to need for a specific purpose in the next couple of years. That's exactly where it should be, sitting in the bank earning next to nothing. Because remember, there's always trade-offs in financial things. So if you are earning a very low rate of interest, the trade-off is that there is no risk that when you need to write that check, the value will be less than you put in. That's the upside of low interest in the bank. No chance of down. So short-term money should be sitting in the bank or in a CD, somewhere nice and secure. When else should you not be investing? If you are scared of downs in your investment accounts, and that makes you likely to pull out, if you do see some negative numbers on your statements, then you really need to think twice. If you don't have someone like me to talk you off of the ledge, then you need to think about it. The fear of regret is a real human emotion, and it's a barrier to wise investing. Remember, it is precisely the risk of ups and downs in investing. That's the reason that we have the potential for higher growth in the long term. So the volatility, the ups and downs, is the price we pay for the chance for higher upside. Remember, on average, the U.S. stock market sees a 5% drop 5 times a year, and a 10% drop on average 1 time a year. Recently, we went 18 months without a single 5% drop. And as human beings, we acclimate and we get to think that's the new normal, and that's not normal. So ups and downs in stock markets, in investing, that's part of the deal. So if that's something that makes you nervous, of course, there are ways to take different levels of risk in your investing. But for your homework this month, I want you to start thinking about risk and reward. Look at how much you've got in the bank. The rule of thumb is that you should have between 3 and 6 months of an emergency fund sitting in the bank for those things that might come up. And then I really do believe you should have more if you're facing some type of transition. If you're facing, say, something like a change of job or a move or expecting a child, potentially a divorce, any of those things argue for having more money in the bank. And then if you've got specific expenses coming up in the next couple of years, if you're planning to, if there's a wedding coming up or a big celebration or a vacation, or you need to buy a new car or a new refrigerator, any of that stuff says that you should have more in the bank. So if you look at those numbers and you've got a lot more than that sitting in the bank, then you need to maybe ask yourself why and think about potentially exposing yourself to a little bit more upside. So I'm signing off for this month. On my website, sofiafinancial.com, you can sign up for a free 20-minute conversation if you'd like to chat more about it. I wish you all a wonderful month and good luck. Take care.